Today, we are diving deep into the US-Iran ceasefire and how that could affect the broad stock market. But before we get into all of that, I just want to remind you all that if you do like this channel, you want to continue following the journey, make sure you subscribe, but also hit the like button. It all helps. But also, we have added a brand new position to the growth on sale portfolio, which I'll be adding around 200 to 300 US dollars a week. So make sure you tune in every single week to get those updates and see how a well-maintained portfolio is made from scratch. Enough of that. Let's get into the crux of the video, talking about the ceasefire deal and the major benefits that will have on the world economy, but more importantly, the stock market. By far the most important aspect in terms of our investing strategy is the impact this has on crude oil prices and also things like natural gas, uranium. A bunch of those have been spiking over the past month, all to do with these tensions surrounding Iran. And to see a historical analysis of this, we're going to take a trip down memory lane. Every single major conflict that has broken out surrounding the Middle East, pretty much all of them, has had a direct impact on crude oil. So we are starting at 1973 in semi-modern times. We have the Yom Kippur War, which again involved Israel and most of the other Arab states. And this led the majority of OPEC, the oil producing countries in the region, to stop giving America oil. And it's very different to how it is today, where actually America is the biggest producer of crude oil. They really depended on it back then. This led to the price of oil quadrupling from $3 a barrel to $12. Speeding up, we had the 1979 Iranian Revolution, and then straight away the Iran-Iraqi War. That led to crude oil more than doubling over that period. We had Gulf War, so Iraq's invasion of Kuwait. And then in 2019, we had some rebel attacks on Saudi oil pipelines or oil producing sites, and that led to 5% of the global oil supply getting knocked out for a short period of time, but that alone sent oil prices up 20% in a single day. And just finishing off the crude oil story here, I just want to show directly how Iran would have cut off about 20% of the world's oil supply, and very easily. What I've got here on this map is the southern end of Iran, or the eastern side of Saudi Arabia. So this is called the Strait of Hormuz, or Hummus, whatever you want to call it. And that is cutting off something called the Arabian Gulf. This is where a huge amount of crude oil, but also natural gas, is produced. Again, about 20% of the world's supply. And to transport all that oil, they use the ocean because, going through the desert would be a huge pain in the butt. This Strait of Hormuz is only a 33-kilometer corridor between Iran and then this tip on the Saudi Arabia coast, but really we're only talking about 6 kilometers of usable sea lanes. So it would be very easy for Iran to send out drones, send out missiles, knock out any sort of ship carrying natural gas, crude oil out of the Arabian Gulf, or they could actually just litter that area with sea mines, pretty much rendering that area useless for an extended period of time. And just showing you here a table of the world's largest oil producers. So the United States is now the biggest producer. I'm going to highlight now in red the countries that would have their oil exports cut off through this blocking of the Strait of Hormuz. And it doesn't take a huge amount of difference in this balancing of supply and demand to have a really big impact to price. So you might even just have a 5% cut of oil supply to the global markets. That could shoot up prices 20, 30, 40% pretty easily. And that's how you would roughly get a 2 to 3 timesing in your oil price. And if we went from $70 a barrel today, we're looking at just over $200 a barrel. Do you think China or Russia really wanted to see the global economy tank? Maybe Russia would like to see that, but China would 100% hate that. So that would leave Iran very isolated. That really left Iran with peace as the only option left on the table. And the markets have already absorbed the details of this ceasefire deal. We've got crude oil down around 20% on that news, and the futures for the stock market are up around 1% with about 6 hours left before trading. And that's really no surprise to anyone, but I think what could be surprising is the extent of this move higher. A 1% gain in stocks is pretty much nothing. I would say that we could be in store for a 20% move higher in the S&P 500 in the next 12 months. I'm going to slowly go through the evidence that points in that direction, but just to tie up in a nice neat bow the Middle East situation, I think pretty much the financial markets are pricing in a Obama-type 2015 deal with Iran, where America could reward Iran financially just by giving them access to the world's markets again. So there was this rumor going around, or just this train of thought, that America was paying Iran in 2015 to stop their nuclear program. But that's actually not quite true. They were just going to give Iran access to about $100 billion of their own foreign financial assets. Again, these have been sealed up since Trump ripped up his deal with Iran in, 2017, whatever it was. And they could also give Iran access to international trading again. So we could have this situation where you have the Saudi Arabia team in the Middle East, paired up with Israel and Jordan and some of these other names, but also the Iranian team with their different little proxies all actually coming down, hopefully in the foreseeable future. And this would take out one giant risk to the markets that has been priced in for about the last 12 months. And again, this is positive for stocks in many different ways, but with the biggest one being crude oil, if we move on to the inflation story, looking at the chart here, we have a 2.4% current yearly inflation rate in America, with crude oil actually spiking in the last few weeks. It was starting to look like inflation could head back up to 3%. But now that crude oil is crashing back down to $60 a barrel, that's starting to point towards 2% yearly inflation for America and also help out the rest of the world. So that already helps out people's checkbooks by lowering their just everyday costs just slightly, but it also means that the interest rate story is starting to get more positive. And by positive, I mean, like in this video I just made today, that interest rates in everyday living, so mortgages, everything like that, bond interest rates, they should be going down. So that link has been above my head. You can click a video to watch that. But we also have the central bank, which could be getting ready to do some rate cuts in the next couple meetings. The probability of the next meeting in, I think it's 38 days, that went from a 10% likelihood of a cut. Now we've gone up to 20% likelihood as soon as that news broke. So we have a pretty nice situation at the moment. We could start to get pretty excited about the market. And we're going to put this together in terms of the classic equation of the price of a stock or the entire market is equal to the earnings or profits timesing your price multiple, your PE ratio. So in terms of the economy, there's a bunch of tech companies that are pushing up the earnings of the entire S&P 500 higher, but you also have maybe the story of lower inflation, but still decent wage growth that could lead to 10% higher profits for S&P 500 companies. So again, that means the earnings arrow is going up, but we also have the picture of the PE ratio. We're getting to a pretty lofty valuation, 21.4 as a 12-month forward PE. But again, I like to give this argument of as soon as we have all of these risks clear up, about 30% of the S&P 500 is high growth tech companies. So with that type of distribution, with really strong earnings growth, we could actually see the forward P ratio go to 22, 23 by middle of 2026, where we have a 10% higher earnings picture for companies, and that's going to multiply with a 10% higher PE ratio. And that's how we arrive at a 20% or 21% increase in the S&P 500 price from today's levels. So let me know in the comments below, do you think this is a serious scenario? Could we see stocks rampage higher as one of the biggest risks have been removed?